Hello and welcome to today's discussion. I'd like to introduce you to a simple but powerful story you can use to help your clients see how maximizing their premium payment can help them accumulate more cash in their IUL policy. We'll demonstrate how this works with a hypothetical example based on an illustration that shows how just an additional $6 per day can potentially turn into over $700,000 of tax-free retirement income. But I'd like to preface our conversation with the purpose of this message. My life insurance career began in 1981, just 2 years after modern-day universal life insurance was introduced. If you recall, back then interest rates were quite high. I remember creating universal life illustrations with projected interest rates of 13.5%. And those illustrations assumed the interest rate would remain at 13.5% for many years into the future. But they didn't. And we all know what happened when interest rates dropped. Policies lapsed. There are serious risks to underfunding a universal life insurance policy. However, there are also advantages to funding them with more than the minimum premium, including the potential to grow significant cash value within the policy. Today's discussion is to help you highlight some of those benefits so your clients can understand the advantages of adequately funding their universal life insurance policies. This story begins with an understanding of the importance of permanent life insurance. Why is permanent life insurance so important? Won't term life insurance do the job? Term life insurance is designed to protect against temporary risks if you die prematurely. For most families, term life insurance is used to help in the event that if a primary breadwinner parent dies unexpectedly, the children can continue to grow up in the same house, help fund a college education, and help replace the deceased breadwinner's income so they may continue living the lifestyle they've become accustomed to. But by the time the parents reach retirement, these issues are normally behind them. The house may be paid off, or at least the mortgage has been paid down significantly. The children may have graduated from college, and because you're retired, you have no more work income to replace. Now, there are other financial concerns that will stay with you throughout your retirement. Any of these concerns could jeopardize your portfolio by themselves. And if more than one of them happens, it can be even more problematic. For example, stock market corrections could significantly reduce the value of your retirement resources. Healthcare costs, especially nursing home costs, could take a significant bite out of what you've saved. And you may just live longer than you expected, in which case additional retirement resources will be necessary. Although term life insurance provides death benefits for your financial concerns you may have if you die within the term, permanent life insurance can help protect against the financial concerns you'll have when you die, no matter when that might be, as long as the policy is properly structured and premiums are paid on time. Once you understand that permanent life insurance is important because of the critical role it plays in your financial future, you can then turn your focus to the additional tax advantages the purchase of permanent life insurance also provides, such as tax-deferred growth of cash values inside the policy, and the ability to access cash value tax-free to use in the future for a wide variety of things. Now let's talk about how you can use these tax advantages to your benefit. When funding a permanent life insurance policy, you know there's a minimum premium and a maximum premium the client can pay. And the difference between the minimum and the maximum may have a much bigger impact on the projected tax-free cash value than you'd ever expect. Without getting into a lot of details about the specifics, I'm going to share the results of illustrations for a completely hypothetical example for a male, age 30, preferred non-tobacco. Understand that this example is completely hypothetical, but the illustrations help you to understand the potential cash value benefits of contributing a small amount of additional premium each month. This hypothetical case is illustrated with the Max Accumulator Plus IUL for a $400,000 death benefit policy using the MLSB index. This example uses an illustrated current rate of 6.5%. When I calculated the minimum premium, here's how I did it. I solved for the premiums necessary that, if stopped at age 65, the illustration would continue to age 110 based on current assumptions as I've previously described. The illustration software calculated that the minimum monthly premium using those assumptions was $170 per month. By the time this client reaches age 65, the premiums paid between age 30 and age 65 totaled $71,400. At age 65, the projected cash value was approximately $79,000. Now, we know this is a completely hypothetical scenario, but if those numbers actually happened, a client in this situation would be able to cancel their policy if he didn't want it anymore, and he'd essentially get all of his premiums back because the cash value approximately equals the premiums paid. Of course, the actual cash value could be more or less than the premiums paid based on the policy's actual performance, but these are the numbers generated on the illustration. If he chose to keep the policy under these assumptions, the policy would continue to age 110, but he wouldn't be able to access any of the cash value because the policy would then lapse prior to age 110, which could put his other financial objectives at risk. The maximum premium he could pay into the policy, based on the guideline maximum premium, would be $340 per month. The difference between this minimum premium and this maximum premium is $170. If you divide $170 by 30 days in a month, that's a difference of premium of less than $6 per day. Do you think he might be able to come up with an additional $6 per day? Why would he want to do that? What would be the potential benefit of contributing the additional premium? Well, using the same assumptions, but paying the $340 per month premium to age 65 results in total premiums of $142,800, exactly double the minimum premium, a total increase of $71,400. But the age 65 projected cash value increases from about $79,000 to about $358,000. That's an increase in projected age 65 cash value of over 4.5 times. But then it gets really interesting. When the maximum premium is paid, this illustration shows that based on these assumptions, he could take loans and withdrawals of $35,700 per year for 20 years, starting at age 65, continuing to age 85, and the policy would remain in force for the rest of his life. That's total retirement distributions of about $714,000. And if it's properly structured, it's all income tax free. Consider IUL for clients who can appreciate the financial security of permanent life insurance and have the ability to contribute additional premium above the minimum. In this hypothetical example, it was just $6 additional per day. The result could be something like the hypothetical example that demonstrated how an additional $6 per day in premium could help contribute to potentially over $700,000 of tax-free retirement income. Now, obviously, this is just one example. Every case will be different, and the premiums will vary based on age, rating, and tobacco. At younger ages, the impact of paying the maximum premium instead of the minimum premium may become more and more significant. At older ages, the impact of paying the maximum premium instead of the minimum premium is reduced. Also, it's important to note that the rates will not necessarily be the same as in the example illustrated. However, I wanted you to think about a different way to help your clients understand and appreciate the financial benefits that can come from contributing just a little extra premium to their indexed universal life insurance policy. Give this concept a try on your next case to help your clients achieve their retirement goals. I hope you found this story to be helpful. Here at AIG, we look forward to providing you with the products, concepts, services, and people that are the hallmark of AIG's reputation. If you have any questions about this concept or anything else related to AIG, please contact us. And have a great day helping your clients achieve and protect their financial goals.